Dear learners, welcome you all for the course Investment Analysis and Portfolio Management. I am Dr. Dinesh, Assistant Professor, School of Management, Shastra Deemed University, Tanjavur. I am going to explain about the major objective for this particular course. So the course objective, it explains the purpose in which the students needs to study this particular course. So the objective of this course is to enable the students to understand the various issues in investment analysis and portfolio management. Since we have different investment options, investment alternatives provided by the various financial institutions. So it is a time that you need to understand, need to know about the nuances in the various investment avenues or the various investment plans or the platforms offered by the financial institutions for better investment to the investors. So the investor should know about what are the alternatives are available, how they are going to select that particular investment avenue. And as a student and the learner, you need to know about the basics of investment and the basics of portfolio management. You need to know about the tools being used for the evaluation of investments. Since you are going for a different investment alternatives. Say for example, you have 1 lakh rupee in your hand. You are going to invest into the market. There are different investment options are available for you. So you need to evaluate those investment options. What way in which I am going to make investment, why I should invest on this particular investment avenue. So you need to say about your time horizon for the investment, the rate of return you are expecting from that particular investment, and about the convenience for making investment. It is like the kind of a document required, the kind of eligibility for enter into the scheme or exit into the scheme or exit into the plan, something. Is there any login period? What about the marketability or the liquidity of that particular investment? The taxability, the purpose in which I am going to make investment. So majority of the people would like to invest into the various investment options for claiming a tax, the tax exemption for those amount what they are making investment into the market. So this is the prime purpose that the learners should understand about the investment point of view. The second important aspect is about the portfolio. So it is diversification of risk. So each investment avenue that should bear a risk associated with the returns. Similar way the portfolio is going to evaluated by the investor. Evaluated from the point of view of learner or the analyst. You are going to evaluating the different portfolio. What is the performance of those portfolio over the period of time? What is the measurement or what is the type of tool you are going to apply in order to evaluate the performance of the portfolio over the period of time? Since the portfolio has given a rate of return that going to adjust the risk. It is going to be the diversified risk. Instead of depending on one particular stock or one particular investment avenue, it is going to invest across the different investment avenues. So the purpose in which the majority of the investor wants to invest in the portfolio. So the first unit is going to deals with the nature and scope of investment decision. So the students, you need to know about the investment, the difference between the investments and saving, what is gambling. You need to know about various investment avenues. Like you can say there are different investment avenues are available. Like banks, post office, invest into the stock market, invest in cash market segment or derivatives, or invest in debt market. There are different investment options are available for the investor. So you need to explore, you need to identify which investment alternative or which investment option is going to suitable for meeting out your investment objectives. So you need to take the decision. You need to take the investment decision. For taking investment decision, there are some fundamental tools that you need to understand. You need to know. It's like the basics of risk and return. Let's say, for example, if you are going to buy a share for rupees 100 in the market, and after a period of time, the market price of particular share available in the market for 120 rupee, during the period you have received a dividend of 10 rupees. So what is the return is being realized by me? So the difference of selling price and the buying price, we call it as capital appreciation. So what is a capital appreciation? I have generated buying and selling of this particular stock in the market. I bought the stock for 100 rupee. I sold the stock for 120 rupee. It means 120 minus 100. The 20 rupee I have generated as capital appreciation. The 20% is a capital appreciation. And another one component of return, we call it as current income. The current income what generated by the particular instrument by means of holding that particular instrument. By holding that particular instrument, the investor has received dividend of 10 rupee. So the 10%, it means 10 divided by 100, the purchasing price. So the 10% is a current income. The overall income generated by the investor, overall rate of return received by the investor by making investment on this particular stock is 30%. So that the investor needs to understand what is the risk and what is the return is associated with the particular investment. Particular investment options that they need to know about that. And the second important aspect, if I'm going to take risk compared to others are going to invest into the debt market, since I'm going to invest into the equity market. So what is the additional rate of return expected by me in the market? So it is going to be understand from the point of view of expected rate of return. By understanding that, what is the return is going to be generated by the market without taking any risk. It is like, you can take an example. There is a concept called risk-free investment. It means if I am going to invest into the government bonds and high security bonds or high security market instruments, if I am going to invest, it doesn't bear any risk, which we technically call it as a zero beta. So it is like a treasury bills issued by the government. So that we assume that if the treasury bill is giving return of 4.2%, without taking any risk, I can generate the return of 4.2% in the market. So if I am going to incur the kind of a risk, I am going to take a kind of a risk in the market, what would be the rate of return is expected? It is going to be the calculation which involved on this particular part in the first unit. And in that, the part of second unit is going to explain, the second unit is going to explain about the valuation of securities. So the part of valuation, you need to understand about the various theories of valuation. The models are available for evaluating the securities. It is like you need to know about how to evaluate the equity shares, how to find out the intrinsic value of such securities which are available in the market, interest bearing securities, determination of interest, the kind of things that you need to understand. The part of this particular unit, you need to know about the efficient market hypothesis. So it is assumed that the market is efficient. How we can say the market is efficient? Market is efficient in terms how the returns are going to be generated by the investor based on the information available in the market, which we call it as intensity of information to determine the market price. So how we can say the intensity of information? It is based on the availability of such information to the market. It is received by the investor. So maybe some information we call it as public information, some information we call it as a private information. Let's say for example the public information, the information have been reported in newspapers, the information have been reported in the television channels. It means those informations are freely available for the public. Some information may not be available for the public, some information which may be available for the private people. It means those people who are associated with the firm can get the information. Let's say for example, if you are as a demat account holder, it is like the depository participant of Kotak Securities. You are the customers of Kotak Securities. So Kotak has their own analytical team. They are looking to that the market, what are the ways in which you are going to make investment into the market. They will give you the report. So that report is available only for the people who are to be the customer of Kotak Securities, which we call it as analyst report. It is private information. So like the public information as well as for the private information has a significant impact to determine the market price. So that is going to be analyzed in the efficiency of market. We can divide the market efficiency into three different forms, call it as weak form of efficiency, semi-strong form of efficiency and strong form of efficiency. So it is going to be analyzed in which the intensity of information is going to be taken on this particular aspect. It is like market related information. We can assume the intensity of information is weak. We can take some public available information along with the market information is going to be the semi-strong form of efficiency. Along with that market information, semi-strong form of information, it's like the public available information. Along with the private report, we can say the market efficiency is too strong. It's going to be analyzed on this. We call it as valuation of securities. And it is going to be the fundamental and technical analysis in the unit 3. The fundamental and technical analysis is a basic or the foundation for investment decisions. So as an investor or as an investment analyst, as a learner, you need to know about the fundamental valuation concepts. So if you are going to make investment into the market, you can take, you're going to invest into the market based on the factors available. You're going to invest into the company. You're going to invest into the longer horizon in the market. For that, the people are preferred to go for fundamental analysis because the fundamental analysis is going to be the three-tier approach. It means like threefold analysis is going to be carried out in the fundamental analysis. At first, the investor is going to analyze or the investment analyst is going to analyze about the economy as a whole. Is going to analyze about the macroeconomic conditions, microeconomic conditions which are prevailing in the market. Later, they understand the industrial scenario, analyzing the industries. Later, we'll move on to the companies, analyzing the fundamentals of companies, key financial ratios of the company, understanding the financial strength of the company. It's a basic thing for the fundamental analysis. Basically, the fundamental analysis is establishing the intrinsic value of such securities which are being traded in the market. So, the fundamental analysis is providing the base. So, based on the fundamental analysis, I can be able to know that what price I can buy this particular stock. Let's say, for example, I have calculated the intrinsic value based on the threefold analysis. It's like I have analyzed about the economy, analyzed about the industry, analyzed about the company. Based on that, I decided to buy this particular stock for 150 rupee. But this particular stock is available in the market for 200 rupee. I can say the particular stock is overvalued in the market. It means overreacted in the market because the intrinsic value is in between the book value and the market value. The value in which the investor can buy the particular stock, what is the real worth of that particular stock is going to be evaluated from the concept of intrinsic value. Let's say the same concept with that the intrinsic value of the securities I have estimated as 150 rupee. It is available in the market for 120 rupee. I can say the stock is undervalued. It is advised to buy it in the market. As an investor, you have to invest into that particular stock. So this is about the basic fundamental valuations and about the technical analysis without seeing the fundamentals, we are not going to in-depth analyzing about the company because I'm not going to invest on the company. I'm just doing for the trading. For the trading purpose, I'm going for technical analysis. So the technical analysis based on the price movement, price and volume related data I can use for understanding that what may be the price movement in future. What would be the trend it is prevailing in the market? Either it may be a bullish trend or a bearish trend in the market. Using some technical charts, I can predict the market. I can make investment for short horizon, the purpose in which I am going to invest into the market. It is about the introduction to the portfolio management. So the fourth and fifth unit is going to deal with the portfolio management. The portfolio is a basket of securities. In spite, I am going to invest into the single asset, I am going to invest into the combination of assets. Various assets I am going to invest. Why I should invest instead of investing into the single asset? Let's say for example, if you have 50,000 rupees in your hand. If you are going to invest the stocks which are listed in NSE, especially for the benchmark index of NSE, we call it as S&P CNX Nifty. Nifty is about the national top 50 companies are included on the basis of weighted average market capitalization. The methodology is being adopted for inclusion of stocks. So if I am going to buy almost the one share for each company together for the 50 companies, it costed around 60 or 70,000. The 50,000 I can't be able to buy. But if I am going to invest in the portfolio, I can even buy a part of the share. That can be possible. Let's say for example, the best example, there is a scheme in ICICI Prudential Asset Management Company called BFSI scheme. The scheme has invested in 31 stock. The scheme has started with a unit price of rupees 10. It is about the 30 paise has invested into the company. The 30 paise of investor has invested. But it is not really possible if I am going to invest as an individual investor or the retail investor. So it is a better option for the retail investor to invest into the portfolio. So the kind of thing in this, you need to know about what is the return risk associated with the portfolio. And you need to know about the CAPM. Is a very important concept that you need to classify the portfolio on the basis of risk and return. It's like the efficient frontier. You need to know what the risk and return is being generated by the portfolio over the period of time. Since it is assumed that over the period of time, it means like a long horizon, what the portfolio may be generated with the higher return with the lower risk. Those stocks or those portfolio is being identified for making investment. Using CAPM, I can able to know that what is the rate of return is expected by the investor to invest into such portfolio. Because each portfolio has its own objective. We call it as investment objective of the portfolio. So on the basis, I'm just using capital asset pricing model for estimating the expected rate of return by the investor and understanding the risk premium associated with the portfolio. The fifth unit is going to be the portfolio construction and evaluation strategy. As an investor, you need to understand that how much you have invested. So in this portfolio construction and evaluation strategy, so it provides the basic that the investor needs to understand how the portfolios are constructed. What is the method adopted by the asset management companies for construction of portfolios? The investment managers for construction of portfolios are explained in this particular unit. This unit provides the basics for understanding different concepts that are associated with the portfolio. It's like there are options are available in the portfolio, like for example, systematic investment plan, systematic withdrawal plan, systematic transfer plan, investment option. It is like a growth option or a dividend option, like we call it as a payout option. What else option is available? And the investor are going to evaluate the portfolio by using different statistical tools that going to measure the risk. It is like the overall risk adjusted return, systematic risk adjusted return, superior risk adjusted return, like the different concept or different ratios have been used for this particular purpose. Sharpe index, Trenner measures, Jensen's alpha are the major methods to be deployed by the investors to evaluate the various portfolios. So these are the things in this Unit 5. These are the basic references that I would like to suggest for the students to go for this, like Fisher and Jordan for security analysis and portfolio management, and Prasanna Chandra investment analysis and portfolio management. Thank you all.